Before we dive in, a quick but important note. The information provided in this video is for educational purposes only and is not intended as financial, legal, or insurance advice. I am not a licensed insurance agent or financial advisor. The world of commercial insurance is incredibly complex and varies by state and individual circumstances. You should always consult with a qualified and licensed professional before making any decisions about your own insurance coverage. This presentation is designed to give you the knowledge to ask the right questions and to better understand the advice you receive from those professionals. There's a ghost that haunts the highways of America. It's the ghost of a brand new trucking business. A business that was born from a dream of freedom, of being your own boss, of controlling your own destiny behind the wheel of 80,000 pounds of rolling thunder. But for 7 out of every 10 new owner-operators, that dream becomes a nightmare and their business is dead within the first year. 7 out of 10. That's a staggering number. And what's the killer? Is it the soaring cost of diesel? The cutthroat competition for loads? The brutal wear and tear on the equipment? No. The number one killer of new trucking authorities, the silent assassin that shuts them down before they even get a chance to build momentum, is insurance. It's a trap, a labyrinth designed to confuse, overwhelm, and drain every last dollar from your pocket. It's a world filled with jargon you don't understand, policies with fine print that can bankrupt you, and agents who might mean well, but often know more about insuring a pizza shop than a Peterbilt. They see a new MC number, they see dollar signs, and they sell you a cookie-cutter policy that leaves you dangerously exposed. And that exposure can be catastrophic. Imagine this, you've done everything right. You saved for years, you bought your rig, you got your authority, and you landed your first big contract. You're on the road, feeling on top of the world. Then a car cuts you off. You swerve. It's not your fault, but there's a multi-car pileup. Suddenly, you're on the receiving end of a lawsuit. And that's when you get the call from your insurance company. The one that says, "We're sorry, but that specific situation isn't covered under your policy." Or worse, your policy limit is $1 million, but the lawsuit is for $5 million. Game over. Your truck is seized. Your savings are gone. Your house is at risk. The dream is shattered. All because of a single sentence buried on page 47 of a policy you never truly understood. This isn't a scare tactic. This happens every single day in the United States. But it does not have to happen to you. What if I told you that you could walk into this labyrinth with a map and a flashlight? What if you could understand the language of insurance so well that you could spot a bad policy from a mile away? What if you could sit across from an insurance agent, not as a victim, but as an expert on your own business, asking the questions that they hope you never ask, and negotiating a policy that protects you like a fortress while saving you thousands, even tens of thousands of dollars a year? That is the promise of this series. Over the next 10 parts, we are going to systematically dismantle the complex world of commercial truck insurance. We are going to expose the common traps, demystify the jargon, and give you a step-by-step playbook for building an insurance package that makes you bulletproof. You will learn what every single coverage does, why you need it, how much of it you need, and how to get it for the best possible price. By the end of this journey, you won't just be a truck driver or a business owner. You will be an educated insurance consumer, empowered to protect your dream, your family, and your future. So let's start right now with the absolute foundation. Before we can even talk about specific coverages like primary liability or cargo, we have to establish 3 fundamental pillars of understanding. Getting these wrong is like building a house on quicksand. Pillar number 1. This is not car insurance. I need you to burn this into your brain. Your personal auto policy that covers your Ford F-150 has almost nothing in common with the insurance you need for a commercial truck. It's like comparing a rowboat to an aircraft carrier. Your personal car represents a certain level of risk. A fully loaded semi-truck barreling down the interstate at 70 miles per hour represents an entirely different universe of risk. The potential for damage, injury, and financial devastation is exponentially higher. A fender bender with your pickup might cost a few $1,000s. A similar incident with your rig can easily climb into the hundreds of thousands or millions before you can even blink. The law recognizes this, the public recognizes this, and believe me, the lawyers who specialize in suing trucking companies definitely recognize this. So the first mental shift you must make is to stop thinking about this as just insurance and start thinking about it as catastrophic risk management. Pillar number 2. Your authority is your lifeline, and insurance is the blood that flows through it. When you get your motor carrier number, your MC number, and your DOT number, you are no longer just a driver. You are a federally regulated entity. The Federal Motor Carrier Safety Administration, or FMCSA, is your new boss, and they have rules. Their biggest rule? You will have active liability insurance on file at all times. The second your insurance lapses, the second there is a cancellation or a problem with the filing, the FMCSA gets an alert, and they will revoke your authority to operate instantly. No grace period. No, we'll give you a week to sort it out. Your authority goes inactive. This means you cannot legally haul a single load for hire across state lines. You are dead in the water. Your truck becomes the world's most expensive lawn ornament. Getting that authority reinstated is a bureaucratic nightmare that costs time and money you don't have. So understand this: your insurance isn't just a bill you pay. It is the life support system for your entire business. And that brings us to the third and most terrifying pillar: the nuclear verdict. This is a term you need to know. A nuclear verdict is a jury award in a lawsuit that is so astronomically high, it goes far beyond compensating for actual damages. We're talking 10 million, 50 million, even hundreds of millions of dollars. And these verdicts are becoming more and more common in lawsuits involving commercial trucks. Why? Because when a lawyer stands in front of a jury and points at you, they don't see a small business owner trying to make a living. They see a giant faceless trucking company with deep pockets. They will use phrases like "a professional driver who should have known better" and "a multi-ton weapon on our highways." They will create a narrative that paints you as the villain, regardless of who was actually at fault in the accident. This is why the federal minimum for liability insurance, which is $750,000, is a joke. It's a death sentence. In today's legal climate, a $1 million liability policy isn't a lot of coverage. It's the absolute bare minimum you need just to get your foot in the door. Most brokers and shippers won't even look at you if you don't have at least 1 million. But even that might not be enough to protect you from a nuclear verdict that could wipe you out completely and follow you for the rest of your life. So let's recap the foundation. 1. This isn't car insurance. It's catastrophic risk management for a high-stakes business. 2. Your insurance is the lifeblood of your operating authority. Without it, your business ceases to exist. And 3. You operate in an environment of nuclear verdicts, where a single accident can lead to financial ruin far beyond what you can imagine. Understanding these three pillars is the first step to taking control. It changes your perspective from "how much is this going to cost me?" to "how well does this protect me?" It shifts you from a place of fear and confusion to a position of power and knowledge. This is the mindset you need to win the insurance game. You're no longer just buying a policy. You are building a financial shield to protect the dream you are working so hard to achieve. So let's start building that shield piece by piece. The first time you look at a commercial truck insurance quote, it feels like you're trying to decipher a secret code. You see acronyms like BI, PD, APD, MTC. It's an alphabet soup designed to confuse, but it's not as complicated as it seems. Think of it like building a suit of armor for your business. Each piece has a specific job, and you can't go into battle with a missing breastplate. The very foundation, the core of this entire suit of armor, is your primary liability coverage. This is the big one. This is the non-negotiable, federally mandated coverage that allows you to even operate legally. If you remember nothing else, remember this: primary liability does not cover you, your truck, or your cargo. Not one penny. Its sole purpose is to pay for the damage you might cause to other people and their property. It's broken down into two simple parts: bodily injury and property damage. Bodily injury, or BI, covers medical bills, pain and suffering, and lost wages for other people if you're at fault in an accident. Property damage, or PD, covers the cost to repair or replace whatever you hit: another car, a light pole, a storefront, you name it. The federal minimum for this is $750,000. Now you might be thinking, 750 grand? That sounds like a lot. And it is. But I want you to picture this scenario. You're driving in heavy city traffic. A car cuts you off, you swerve, and you end up rear-ending a city bus during rush hour. You didn't just cause a little whiplash. You have multiple injuries, a heavily damaged bus that costs a fortune to repair, and a city that's going to bill you for the traffic disruption and cleanup. Suddenly, $750,000 doesn't look so big. In fact, most reputable shippers and brokers won't even work with you unless you have at least $1 million in liability coverage. That $1 million limit is the industry standard. It's the price of admission to the best-paying loads. Cutting corners here isn't saving money. It's locking yourself out of opportunity and exposing your entire life to a single lawsuit. This is the breastplate of your armor. Without it, you're completely vulnerable. Okay, so your liability coverage protects everyone else. But what about the single biggest investment you've probably made in your entire life? Your truck. That beautiful rig that costs more than most houses. That's where physical damage coverage comes in. This is the part of the armor that protects you. Physical damage, or FMCSA, is also split into two main parts: collision and comprehensive. Collision is exactly what it sounds like. It pays to repair or replace your truck if it's damaged in a collision with another object. This could be another vehicle, a guardrail, a building, or even just the ground in the case of a rollover. Let's say you hit a patch of black ice on a mountain pass in Wyoming. You do everything right, but the trailer starts to slide and you end up on your side in a ditch. The damage is catastrophic. Your collision coverage is what buys you a new truck or pays for the tens of thousands of dollars in repairs. Then you have comprehensive coverage. I like to call this the life happens coverage. It's for damage to your truck from almost anything other than a collision. Think of fire, theft, vandalism, hitting a deer, a hailstorm that makes your hood look like a golf ball, or a tree branch falling on your cab during a storm. It's for all the freak accidents and acts of God that you have no control over. I know a driver who parked his rig for a 34-hour reset at a well-lit, reputable truck stop. He came out in the morning and it was just gone. Vanished. The feeling of absolute violation and helplessness is something he'll never forget. But his comprehensive coverage is what allowed him to get back on the road. Without it, his career would have been over right there in that parking lot. Together, collision and comprehensive are the gauntlets and helmet of your armor. They protect the very machine that allows you to earn a living. Now we've protected other people and we've protected your truck. What's left? The one thing you're actually getting paid for, the cargo. This is where motor truck cargo insurance, or MTC, comes into play. This coverage protects the freight you are hauling in case it's lost or damaged due to things like a fire, a collision, or theft. Do not underestimate the importance of this. Hauling freight without cargo insurance is like being a trapeze artist without a net. You're one slip away from total disaster. Imagine you're hauling a refrigerated trailer, a reefer, full of high-end electronics from California to New York. Somewhere in Nebraska, your reefer unit fails overnight. The entire load is compromised by condensation and temperature fluctuations. We're talking about a $100,000 load. The shipper isn't going to just say, "Oh well, tough luck." They are going to demand that you pay for their lost product. Without motor truck cargo insurance, that claim comes directly out of your pocket. It's a business-ending, life-altering mistake. Your cargo coverage isn't just about protecting the goods. It's about protecting your reputation and your authority. Next up is one of the most misunderstood areas of truck insurance: the difference between non-trucking liability and bobtail insurance. People use these terms interchangeably, but they are critically different, and getting the wrong one can be a costly mistake. Both coverages are for owner-operators who are leased on to a motor carrier. When you are under dispatch for that carrier, their primary liability insurance is covering you. But what happens when you're not? Let's start with non-trucking liability. This is what 99% of leased owner-operators need. It provides liability coverage when you use your truck for personal, non-business purposes. You drop off your load in Atlanta. Your next pickup isn't until Monday morning. On Saturday, you use your tractor without the trailer to go to the grocery store, visit a friend, or go to the movies. You are not on the clock. You are on your own personal time. If you cause an accident, then your motor carrier's insurance will deny the claim. Non-trucking liability is the policy that steps in to protect you. Bobtail insurance, on the other hand, is much narrower and far less common. It covers you only when you're driving your tractor without a trailer, but you are still under dispatch, for example, driving from the terminal to pick up a load, or driving back to the yard after dropping a trailer. Because you're still technically working for the motor carrier in these situations, their primary liability almost always covers this, making a separate bobtail policy redundant and unnecessary for most drivers. So if an agent is trying to sell you bobtail, ask them if they really mean non-trucking liability. Knowing the difference proves you've done your homework. Finally, there's a crucial piece of armor for anyone involved in intermodal, or who pulls other people's trailers: trailer interchange insurance. This is a type of physical damage coverage for trailers you don't own. Under a trailer interchange agreement, you are responsible for any damage that happens to that trailer while it's in your possession. You hook up to a brand new 53-foot dry van. While you're backing into a tight spot, you misjudge and crunch the corner against a concrete post. Trailer interchange insurance is what pays to repair that trailer, so you don't get a massive bill from the trailer's owner. It's the coverage that protects you while you're responsible for someone else's very expensive equipment. So there you have it. Primary liability, the breastplate that protects the world from you. Physical damage, the helmet and gauntlets that protect your truck. Motor truck cargo, the shield that protects your load and your reputation. And the specialty coverages like non-trucking and trailer interchange that fill in the gaps. These are the fundamental pieces of your financial suit of armor. You now understand what they are and why you need them. You're no longer just looking at a list of acronyms. You're looking at a strategy for survival and success. Now that you know what the pieces of the armor are, the next critical question is, how strong does each piece need to be? How much coverage is enough, and how do those numbers directly impact the price you pay? This is the fundamental question, the one that separates a business built on a rock from one built on sand. And the answer isn't a single number. It's a strategic calculation. Let's start with the big one, the 800-pound gorilla in the room. Primary auto liability. The federal government, through the FMCSA, mandates a minimum. For most general freight carriers, that number is $750,000. 750. And I'm here to tell you that number is a trap. It's a siren song luring new owner-operators onto the rocks of financial ruin. Yes, it will get you your authority. Yes, it is technically legal. But in the real world, it is practically useless. Think of it this way. Getting the minimum required insurance is like showing up to a gunfight with the smallest legal pocket knife. You've met the legal requirement to carry a weapon, but you are not prepared for the fight. No reputable broker, no major shipper, will even look at a carrier with only $750,000 in liability coverage. They know the risks. They've seen the lawsuits. They know that a single, moderately serious accident can blow past that limit before the lawyers even finish their morning coffee. So what's the real number? The true entry fee to this industry? $1 million. Period. A $1 million combined single limit, or CSL, is the undisputed industry standard. This means you have $1 million pool of money available to cover bodily injury and property damage in any combination for a single accident. This is the number that brokers and shippers look for on your certificate of insurance. It's the number that says, I am a professional. I understand the stakes. I am a safe bet. Without it, you're invisible. You're stuck hauling cheap freight from the bottom of the barrel load boards if you can even get that. But here's the scary part, the part that keeps seasoned fleet owners up at night. In today's world, even $1 million might not be enough. We live in the age of the nuclear verdict. These are jury awards and accident lawsuits that go far beyond simple compensation. They are astronomical, multi-million-dollar judgments that can vaporize a trucking company overnight. A decade ago, a $10 million verdict was shocking. Today, verdicts of $20, $30, even $100 million are becoming terrifyingly common. Imagine a multi-vehicle pileup on a foggy morning. Your truck is involved. Even if you're not entirely at fault, you have the deepest pockets. You are the commercial vehicle, the professional driver. The plaintiff's attorneys will paint a picture of a massive, dangerous machine operated by a faceless corporation. And a sympathetic jury, seeing catastrophic injuries, can award a sum that your $1 million policy can't even begin to cover. This is where umbrella or excess liability insurance comes in. It's a second policy that sits on top of your primary $1 million policy. It doesn't kick in until your primary policy is completely exhausted. So, you might have a $1 million primary policy and a $2 million umbrella policy on top of it, giving you a total of $3 million in liability protection. Do you need it starting out? Maybe not. But as you grow, as you add trucks, as you start hauling for major national brands, it becomes an absolute necessity. Many high-value contracts will explicitly require it. It's the difference between surviving a catastrophic event and having your entire life's work, your home, your savings, liquidated to pay a judgment. Now let's shift gears from protecting the public to protecting the load. Motor truck cargo insurance. How much do you need? This isn't a one-size-fits-all answer. It depends entirely on what you haul. If you're hauling loads of gravel or scrap metal, the value is relatively low. A policy with a $100,000 limit is probably more than enough. In fact, most brokers and shippers require that as the standard minimum. But what if you get a contract to haul a load of brand new laptops? Or a refrigerated trailer full of pharmaceuticals? That $100,000 limit won't even cover a fraction of the loss if something goes wrong. If that reefer unit fails and the entire load of medicine spoils, you are on the hook for the entire value. If you only have $100,000 in coverage for a $300,000 load, that $200,000 difference is coming directly out of your pocket. So you must be strategic. The key is to have enough cargo coverage for the most valuable loads you plan to haul. Don't pay for a $500,000 policy if you only ever haul produce worth $75,000. But don't you dare accept a load of electronics worth $200,000 if your policy tops out at 100. It's a simple math problem that can save or destroy your business. Next up is physical damage coverage, the policy that protects your truck and trailer. This is where you have some direct control over your premium through a powerful tool. The deductible. A deductible is the amount of money you agree to pay out of pocket for a claim before the insurance company pays a dime. They typically range from $1,000 up to $5,000, or even $10,000. The rule is simple. The higher your deductible, the lower your premium. Why? Because you are taking on more of the initial risk yourself. The insurance company knows that if you have a $5,000 deductible, you're not going to file a claim for a $2,000 fender bender. It reduces their small claims paperwork and exposure. This is a business decision for you. If you have a healthy cash reserve, a rainy day fund, you might opt for a higher deductible to save hundreds, maybe thousands of dollars a year on your premium. But if you're running lean and a $5,000 surprise expense would cripple you, then a lower deductible, despite the higher premium, is the safer bet. It's a trade-off between your monthly cash flow and your emergency financial strength. But there's another critical detail with physical damage: how the value of your equipment is determined. You'll usually see two options: stated amount or actual cash value. Stated amount is where you and the insurer agree on a specific value for your truck when you buy the policy. It sounds good, but be careful. In the event of a total loss, they will pay the stated amount or the actual cash value, whichever is less. And that brings us to actual cash value, or ACV. This is the most common method. ACV is not what you paid for the truck. It's not what you owe on the truck. It is what your truck is worth in the open market the second before the crash. It's the original cost minus depreciation. A brand new $200,000 rig might only have an ACV of $150,000 after 3 years of hard miles. If that truck is totaled, the insurance company is writing you a check for $150,000, even if you still owe $170,000 on your loan. That $20,000 gap? That's your problem. This is precisely why gap insurance exists, to cover that difference between what you owe and what the truck is actually worth. So you see, it's a complex dance of numbers. $1 million in liability is the price of admission. Cargo coverage must match your freight. And your physical damage limits and deductibles need to align with your personal financial reality. Getting the cheapest possible quote is almost always a mistake, because that savings is created by cutting your limits, raising your deductibles, or undervaluing your equipment, leaving you dangerously exposed. We've now covered the types of armor you need and the necessary strength of each piece. We've established the baseline for operating as a true professional in this industry. But all of this leads to the most personal question of all. With these limits in mind, how is the final price, your premium, actually calculated? What factors about you, your history, and your business operations are put under a microscope by the underwriters? Because they're not just insuring your truck, they're insuring you. And the story your data tells will have the single biggest impact on the number you see at the bottom of that quote. So let's step into the shoes of that underwriter for a moment. Imagine their desk. On one side, a file for a 5-truck fleet in Ohio. On the other, a file for an identical 5-truck fleet, running the same lanes, hauling the same freight. The underwriter spends an hour reviewing both. At the end, one file gets stamped with a premium of $60,000 a year. The other gets a stamp that reads "Declined to quote." They won't even offer a price. Why? What was in that second file that was so terrifying? It all comes down to the dossier they build on you. A deep dive into your history that tells them everything they need to know about your future. The first and most personal document in that dossier is your MVR, your motor vehicle record. This is the official story of you, the driver, as told by every DMV and law enforcement agency you've ever encountered. To an insurer, a clean MVR is like a letter of recommendation from the entire U.S. highway system. Says you're professional, you're predictable, and you're a good risk. But a single speeding ticket? To you, that might be a frustrating afternoon and a few $100. To an underwriter, it's a red flare. They don't see a driver who is 10 miles over the limit. They see a driver who is comfortable breaking the rules. They see a pattern of behavior that increases the probability of a catastrophic event. A truck going 75 miles per hour instead of 65 doesn't just have a little more energy. It has exponentially more. The force of impact, the severity of the accident, the cost of the claim, it all skyrockets. Let's picture two owner-operators. We'll call them David and Michael. Both are 45 years old, have 10 years of experience, and drive the same model Peterbilt. David has a spotless MVR. For the last 3 years, not a single moving violation. Michael has one speeding ticket from 18 months ago, 15 over in a 65. When the underwriter pulls their MVRs, David's file gets a green check mark. He's placed in the preferred risk category. Michael's file gets a yellow flag. That one ticket might bump his base rate by 15 or 20%. That's not a one-time penalty. That's thousands of dollars every single year, all because of one moment of heavy footing. If he had 2 tickets or an at-fault accident, he might be pushed into a high-risk pool where premiums are double, or he could be denied coverage altogether. The MVR isn't just a record of your past. It's the insurer's crystal ball for your future. But they don't stop with the driver. They zoom out to look at your entire operation, and for that, they turn to the second critical document, your CSA score. Compliance, Safety, Accountability. This is your company's report card. Issued by the Federal Motor Carrier Safety Administration, the FMCSA. It's a public-facing score that grades your company on its safety performance, based on roadside inspections and crash data. And insurers are obsessed with it. They focus on a few key categories or basics. The first is unsafe driving. This is where Michael's speeding ticket shows up again, not just on his personal MVR, but as a black mark against his entire company's record. The second is hours of service compliance. Are your drivers fudging their logbooks? Are they driving tired? To an underwriter, an hours of service violation is one of the most terrifying things they can see. A fatigued driver is as dangerous as an intoxicated one, and the claims that result from falling asleep at the wheel are biblical in scale. The third, and perhaps most revealing, is vehicle maintenance. Let's go back to David and Michael. David is meticulous. His pre-trip and post-trip inspections are non-negotiable. His tires have good tread, his lights all work, his brakes are perfectly adjusted. His company has a stellar vehicle maintenance CSA score, because roadside inspectors never find anything wrong. Michael is a little more relaxed. He fixes things when they break. One day, he gets pulled in for a level 1 inspection, and the officer finds a burned-out marker light and brakes that are slightly out of adjustment. To Michael, it's an annoyance, a fix-it ticket, but to the insurance underwriter looking at his CSA score, that broken light is a symptom of a deadly disease, a poor maintenance culture. Their thinking is brutally simple. If he's letting a $5 bulb go, what else is he letting go? Are his tires about to blow? Is his steering failing? They don't see a minor violation. They see a multi-million-dollar lawsuit waiting to happen. A bad score in this category can make you completely uninsurable with the best carriers. You're radioactive. David, with his clean CSA scores, is getting quotes from A-rated insurance companies with great coverage and service. Michael, with his dings and violations, is forced into the E&S market, the excess and surplus lines, where the premiums are astronomical and the coverage is often weaker. So the underwriter has the driver's story from the MVR and the company's story from the CSA score. Now they need the final piece of the puzzle, the ultimate proof of your past performance. They need your loss runs. A loss run is a report from your previous insurance carriers detailing every single claim you've ever had. It's the unvarnished truth. You can say you're a safe operation, but your loss runs prove it or disprove it. David's loss runs are pristine. 5 years in business and not a single claim. This is the holy grail for an underwriter. It confirms everything the MVR and CSA scores suggested. He's not just talking the talk, he's walking the walk. He is the definition of a low-risk client. Michael's loss runs tell a different story. 4 years ago, he had a minor cargo claim. A pallet shifted and a few $1,000s worth of electronics were damaged. 2 years ago, he had a small incident where he backed into a pole at a truck stop, causing about $5,000 in damage to his trailer. Neither of these were huge, catastrophic events, but to the underwriter, this shows a pattern. It's what they call frequency, and in many ways, they fear frequency more than severity. One massive freak accident can be explained away as bad luck, but 2, 3, or 4 small claims, that suggests a systemic problem. It points to a lack of training, a lack of proper procedure, or just plain carelessness. The underwriter will dig into each of those claims. Why did that cargo shift? Was it improperly loaded? Was the driver going too fast around a corner? Why did he back into a pole? Was he tired? Was he not paying attention? Was he using a spotter? Each claim is a clue. And when they see a frequency of claims, the price goes up dramatically. They are no longer just insuring you against the possibility of a random accident. They are now pricing in the high probability that your operational habits will lead to more claims in the future. This is the trifecta: the MVR, the CSA score, and the loss runs. Together, they create a high-definition picture of your entire business. They tell a story that no slick sales pitch can cover up. It's a story written in data, and it's the reason why David, with his identical truck and business, gets that preferred $60,000 quote, while Michael gets the dreaded decline to quote stamp or a desperation quote for $120,000. The risk wasn't in the chrome or the engine. It was in the history. It was in the data. So you've seen how they judge your past. But what about your future? What about the cargo you haul, the routes you drive, and the contracts you sign? That's where the risk assessment gets even more personal and even more expensive. We're about to peel back the curtain on the commodities and routes that can make your insurance skyrocket, or even make you completely uninsurable. So, you think all freight is created equal? You think hauling a truckload of toilet paper from a warehouse in Ohio to a distribution center in Indiana carries the same weight in an underwriter's mind as hauling a tanker of anhydrous ammonia through downtown Chicago? It's a laughable thought, but it's a mistake new owner-operators make every single day. They see the dollar signs on a load board, they sign the contract, and then they call their insurance agent, only to be met with a dial tone. Or worse, a policy cancellation notice. What you haul, and where you haul it, are the two most powerful levers an insurance company can pull to either triple your premium or drop you like a hot rock. This isn't about your driving record anymore. This is about the inherent risk baked into the very fabric of your business operations. Think of it this way: your standard $1 million liability policy is designed for a predictable level of risk. It's for hauling things that, if they spill on the highway, a crew can clean up with a shovel and a broom. We're talking lumber, canned goods, textiles, palletized freight. This is the bread and butter of the industry, the low-risk, steady-eddy cargo that keeps the country moving and insurance underwriters sleeping soundly at night. If this is all you ever plan to haul, congratulations, you're in the safest, most affordable insurance bracket for cargo. But let's be honest, the real money, the kind of money that builds fleets and secures retirements, often lies just outside that comfort zone. Let's move up the risk ladder. What about refrigerated goods? A reefer unit full of fresh produce or frozen meat. Suddenly, you've introduced a new variable: time and temperature. If your reefer unit fails in the middle of Arizona in July, that's not an accident, but it is a $100,000 claim waiting to happen. Your entire load is now a ticking clock, and your insurance company knows it. That potential for spoilage, for a total loss without a single collision, means you need specific reefer breakdown coverage, and your premium just took a noticeable step up. Now let's talk about theft. You land a contract hauling high-end electronics, pharmaceuticals, or designer apparel. To you, that's a great payday. To an underwriter, that's a rolling Fort Knox with a bullseye painted on the side. They aren't just looking at accident statistics anymore. They are pulling up cargo theft heat maps from organizations like CargoNet. They know which truck stops in Florida, which warehouses in California, and which stretches of highway in Texas are hotspots for organized cargo theft rings. If your regular route takes you through one of these red zones with a trailer full of iPhones, your risk profile just exploded. You'll be required to have higher cargo limits, and the insurer will want to know about your security protocols. Do you have GPS tracking, kill switches, high security locks? If you don't, you might not even get a quote. But even that pales in comparison to the true top tier of risk. Let's talk about the heavy hitters. Hazardous materials. The moment you decide to get your hazmat endorsement and put those placards on your truck, you have fundamentally changed the conversation with your insurer. You are no longer just a traffic risk. You are a potential environmental catastrophe. A simple fender bender is no longer simple. It's a potential leak, a potential evacuation, a potential multi-million-dollar cleanup operation involving guys in hazmat suits. Your $1 million liability policy? It's a joke. The Federal Motor Carrier Safety Administration, the FMCSA, mandates a minimum of $5 million in liability coverage for most hazmat haulers. $5 million. And that's the floor. Most shippers and brokers will contractually require even more. Your premium doesn't just go up, it enters a different orbit. And it's not just chemicals. Oversized or overweight loads are another beast entirely. You're not just driving a truck, you're piloting a building down the highway. This requires special permits, escort vehicles, and route planning that avoids bridges and power lines. The potential for catastrophic property damage is immense. One miscalculation, one tight turn, and you haven't just caused an accident. You've taken out a piece of public infrastructure. The liability is staggering, and the insurance premiums reflect every single dollar of that potential devastation. Then there's the stuff that many insurers just won't touch at all. The uninsurable list. This isn't a formal, published document, but it exists in the underwriting guidelines of every major carrier. Try getting a standard policy to haul medical waste, radioactive materials, or certain classes of explosives. You'll be funneled into an incredibly niche, incredibly expensive corner of the insurance market, if you can find coverage at all. Some mainstream insurers have blanket exclusions. They won't cover logging operations because of the dangerous off-road conditions, or they won't cover mobile home transport because of the unique risks involved. You could have a perfect driving record, but if you haul a blacklisted commodity, you are an unacceptable risk. Period. Now let's stack another layer of complexity on top of this. The route. It's not just what you're hauling, but where you're taking it. The concept is called your radius of operation. Are you a local guy staying within a 100-mile radius of your home base, sleeping in your own bed every night? Or are you an over-the-road, long-haul driver crossing 48 states? The long-haul driver is exposed to more miles, more weather patterns, more traffic, and more unfamiliar roads. More exposure equals more risk, which equals higher premiums. But it gets even more granular than that. Insurers are now using incredibly sophisticated data to price routes, almost down to the specific highway. A run from Dallas to Houston on I-45, one of the most dangerous stretches of interstate in the country, is priced differently than a straight shot across the flatlands of I-80 in Nebraska. Hauling steel through the steep, winding grades of the Rocky Mountains in Colorado in January is a world away from hauling it across the Florida Panhandle in May. They factor in weather data. Are you operating in the snowbelt or Hurricane Alley? They factor in traffic density. A truck that spends 80% of its time navigating the gridlock of Los Angeles, New York, or Atlanta is a far greater risk for a fender bender than one cruising through rural Wyoming. Your garaging address, the place where you park your truck at night, sets the entire baseline. A trucker based in a major metropolitan area with high accident and theft rates, like Miami or Chicago, is going to pay a significantly higher base premium than a trucker based in a quiet, rural town in the Midwest, even if they drive the exact same number of miles. The underwriters believe risk starts at home. So how does this all come together in the real world? It comes together in the contract you're about to sign with a broker. That contract will specify the commodity, the origin, and the destination. Before you sign it, before you even agree to it verbally, that is the moment you should be on the phone with your insurance agent. You need to ask one simple question. Am I covered for this? Don't assume. A standard policy might have an exclusion for a certain type of hazardous material you've never hauled before. Your cargo insurance might be for $50,000, but this new load of pharmaceuticals is worth $200,000. If you haul it without increasing your coverage, you are personally on the hook for the $150,000 difference. Your agent can add an endorsement or a rider for a specific trip, but you have to make the call. The worst thing you can do is engage in what the industry calls blind hauling. Hauling something you're not supposed to, hoping you don't get caught. If you have an accident and the insurance company discovers you were hauling a prohibited commodity or were operating way outside your stated radius, they have every right to deny the claim. Not some of the claim, all of it. They will walk away, and you will be left with the financial, legal, and medical fallout all by yourself. It's a gamble that has bankrupted countless trucking businesses. The cargo you carry and the roads you travel upon are the lifeblood of your operation, but they are also a minefield of risk. Every choice you make, every load you accept is a financial calculation. But what if the biggest risk isn't the cargo or the route? What if the most dangerous variable, the thing that could be silently draining your bank account or setting you up for a denied claim, is the very machine you're driving? You could be hauling the safest cargo on the safest route in America, but if you're behind the wheel of the wrong truck, none of it matters. In fact, the rig you love, the rig you've invested your life savings into, could be a ticking time bomb on your insurance policy, and you might not even know why. So what makes a truck a ticking time bomb for your insurance? It's the simple, brutal fact that underwriters don't just insure you, the driver. They insure the machine. And every single detail about that machine, from the year it was built to the chrome on its grille, is a variable in a complex equation of risk. An equation that can either save you a fortune or cost you your business. Let's start with the most common trap. The age of the truck. You see a 2005 Peterbilt 379. It's a legend. Long nose, classic lines, 1,000,000 miles on the clock, and it still runs like a dream. It's half the price of a new truck, the engine is pre-emission, easier to work on, and you think, I've hit the jackpot. Low truck payment, more money in my pocket. But then you call for an insurance quote, and the number they give you back is so high you think it's a typo. What happened? From an underwriter's perspective, that classic rig isn't a symbol of freedom. It's a rolling liability. First, think about physical damage coverage. If that 20-year-old truck gets into a wreck, where does the repair shop find the parts? They can't just order a new OEM hood or fender. They have to scour salvage yards or find specialty fabricators. This takes time and costs a fortune. A simple fender bender that would take a week to fix on a new truck can turn into a month-long ordeal for an older one. More downtime for the truck means a bigger potential claim for the insurance company, so they charge you more upfront to cover that risk. But the bigger issue is liability. Your 2005 Legend has none of the safety technology that is now standard. A 2024 Freightliner Cascadia has collision mitigation systems that can automatically apply the brakes to prevent a rear-end collision. It has lane departure warnings, stability control, and advanced aerodynamic designs. Your classic rig has good brakes in you. That's it. To an insurer, that technology isn't a luxury. It's a critical risk reduction tool. They have mountains of data showing that trucks equipped with these systems have fewer and less severe accidents. So when they see a truck without them, they don't see a classic. They see a higher probability of a catastrophic, multi-million-dollar nuclear verdict. And your premium will reflect that terrifying reality. They are literally charging you for the absence of technology. Next, let's talk make and model. Not all trucks are created equal in the eyes of an insurer. A brand new, top-of-the-line, fully loaded Kenworth W900 with a price tag of $250,000 is going to have a much higher physical damage premium than a base model Volvo VNL that costs $170,000. It's simple math. The stated value or actual cash value of the truck is a foundational component of the premium. The more the insurer would have to pay to replace it, the more you have to pay to protect it. But it goes deeper than just the price tag. Insurers track claims data by make and model. They know which trucks have higher repair costs, which ones are targeted by thieves, and which ones are more frequently involved in rollovers. For example, some lighter-duty trucks used in certain industries might have a history of being overloaded, leading to more frequent brake and frame issues, which translates to higher risk. Certain models might be known as theft magnets, especially in specific regions like Southern California or South Florida. If you own a truck that's on their internal most stolen list, your premium for comprehensive coverage, which covers theft, is going to be higher. It has nothing to do with you as a driver. It's about the risk profile of the asset itself. This brings us to one of the biggest factors of all, the gross vehicle weight, or GVW. This is the maximum operating weight of your truck, fully loaded. Your insurance premium is directly and dramatically impacted by this number. Think about it from a pure physics standpoint. The amount of damage a vehicle can do is a function of its mass and speed. A hotshot driver in a Ram 3500, pulling a 40-foot gooseneck with a combined weight of 30,000 pounds, represents a certain level of risk. But a Class 8 tractor-trailer hauling steel coils at 80,000 pounds? That's an entirely different universe of potential destruction. An 80,000-pound vehicle colliding with a minivan isn't an accident. It's a catastrophic event. The potential for fatalities and life-altering injuries is immense. Insurers know that a claim involving a fully loaded Class 8 truck is never ever small. The liability exposure is astronomical. That's why a brand new owner-operator with a new authority, trying to insure an 80,000-pound GVW rig, will face some of the highest premiums in the entire industry. The underwriters are pricing in the absolute worst-case scenario, because with that much weight, the worst-case scenario is always a possibility. This is also why you must be deadly accurate when you tell your agent your GVW. If you say you're running at 65,000 pounds to get a lower rate, but then you get in an accident while hauling 80,000 pounds, you've just given your insurance company a golden ticket to deny your claim entirely for misrepresentation. And finally, we have the modification trap. Truckers love their trucks. They pour their heart, soul, and a lot of money into them. Custom paint, extra chrome, moose bumpers, stretched frames, custom sleepers, tuned-up engines. It's a part of the culture. But every single one of those modifications is a red flag for an underwriter. Why? Because it introduces unknowns. A standard factory-built truck is a known quantity. The insurer knows its value, its repair costs, and its performance specs. The moment you start modifying it, you change the equation. That $50,000 custom paint job? It's beautiful, but now a simple scratch can't just be fixed at any body shop. It requires a specialist, driving the cost of repair through the roof. That engine tune that gives you an extra 100 horsepower? To you, that's power to get over the mountains. To an insurer, that's an unauthorized modification that could increase the risk of speeding and put extra strain on the factory drivetrain, potentially leading to mechanical failure. The most dangerous part is failing to disclose these modifications. Let's say you've added $60,000 in custom chrome and accessories to your truck, but your stated value on the policy is still the stock factory value. If that truck is totaled, the insurance company is only obligated to pay you for a stock factory truck. That 60 grand you invested? It's gone. Vaporized. You have to specifically insure that extra value, which means paying a higher premium. Many drivers don't, and they learn a devastating lesson when it's far too late. They essentially self-insured their own custom work without even realizing it. So you see, the truck itself is its own character in your insurance story. Its age, its safety features, its brand, its weight, and its customizations all weave together to create a risk profile. You could be the safest driver in the world with a 20-year clean record, but if you choose a truck that underwriters see as a high-risk machine, you will pay the price. You have to think like an underwriter when you go truck shopping. You have to look past the chrome and the horsepower and ask, how will an insurance company see this vehicle? Answering that question honestly before you sign the paperwork can be the difference between a profitable career and a financial nightmare. You've meticulously chosen the right rig, navigating the minefield of age, make, and model. It's safe, it's modern, and your insurance quote is manageable. You're finally ready to hit the road. But then you back up to the dock and hook up to your first load. And in that moment, you're about to discover that what you put inside the trailer can be infinitely more dangerous to your business and your insurance rates than the truck itself. That load is a sealed trailer full of prime American beef, headed from a packing plant in Nebraska to a high-end distributor in New York City. 40,000 pounds of it. The bill of lading says it's worth $125,000. Now you're smart. You did your research. You called your insurance agent and got a motor truck cargo policy. You told them you needed the industry standard $100,000 in coverage. The agent said, no problem, and sent you the certificate. You're covered. You feel that sense of relief as you pull out of the yard. The reefer unit humming behind you. You're a real trucker now, moving the goods that feed America. But what you don't know is that the policy you just bought isn't a safety net. It's a minefield, and you're driving right through the middle of it completely blind. This is the part of the insurance puzzle that sinks more trucking businesses than any other. Motor truck cargo. Sounds so simple. Covers the cargo. But the devil isn't just in the details. He owns the whole printing press. Let's go back to that $100,000 limit. You see that number and you think, great, if I'm hauling a load worth less than 100 grand, I'm good. That is the single most dangerous assumption in this entire industry. Your cargo policy isn't a blanket check for up to $100,000. It's a complex contract with a list of exclusions, limitations, and conditions longer than the list of excuses your dispatcher gives you. Let's imagine you're halfway to New York, somewhere in Pennsylvania. You pull over for your 10-hour break at a truck stop. You do everything right. You find a well-lit spot, you lock your truck, you go inside. The next morning you come out, and the seal on your trailer is broken. You open the doors, and a quarter of the beef is gone. A professional crew hit the lot overnight and cleaned you out. You call the police, you file a report, and then you call your insurance company, expecting them to cover the $30,000 in stolen meat. And that's when you get your first lesson. The claims adjuster asks, was the truck in a secured, fenced-in yard? You say no, it was a public truck stop. And he says, I'm sorry, but your policy has an unattended vehicle exclusion. Unless the vehicle is in a fully fenced, locked, and monitored facility, theft is not covered. Just like that, you are on the hook for $30,000. Your profit for the next 6 months? Gone. But let's change the scenario. Let's say there was no theft. Instead, you get into an accident. Someone cuts you off, you swerve to avoid them, and your rig jackknifes rolling onto its side in the median. You're okay, thankfully, but the trailer is mangled. The load of beef is scattered across the highway. The police and fire departments are there, and they're telling you that you need to get this mess cleaned up now. You call your insurance. You have a $100,000 cargo policy. The load was worth $125,000. You know you'll have to eat the $25,000 difference, plus your deductible, maybe $1,000 or $5,000. It's a painful hit, but you'll survive. Then the second lesson hits you. The adjuster tells you that your policy does not include debris removal coverage. That means the insurance will pay for the lost cargo, but the cost of hiring the cranes, the front-end loaders, the cleanup crew, and the environmental team to scrape 40,000 pounds of spoiled beef off the interstate? That's all on you. You get a bill a week later for $40,000. Now you're out the $25,000 your policy didn't cover, your $5,000 deductible, and $40,000 for the cleanup. You're $70,000 in the hole from one accident where you weren't even at fault. But it gets worse. Let's rewind again. The accident happens, but the trailer stays upright. It's damaged, but the load is still inside. The reefer unit, however, was smashed in the collision and has stopped working. It's a hot July day. You call a heavy-duty tow truck to get your rig to a repair yard. While you're waiting, the clock is ticking. The temperature inside that trailer is rising. The tow takes 4 hours to arrive. By the time you get to a yard, the beef has been sitting without refrigeration for 6 hours. The receiver in New York gets word of the accident and immediately rejects the entire load, citing the temperature breach. They don't even need to see it. Their contract says if the temperature goes out of range for more than 30 minutes, the product is considered contaminated. So now you have a total loss, $125,000. You file the claim. The adjuster asks for your reefer's temperature log. You provide it, and he points to a clause in your policy, a very common one called the reefer breakdown endorsement. It says it will cover spoilage if and only if the breakdown was due to the mechanical failure of the unit itself. But in your case, the reefer didn't fail on its own. It was damaged in a collision. And your main cargo policy has an exclusion for spoilage due to collision. You're caught in a gap. One policy says it's the other's fault. The insurance company denies your claim. You are now personally on the hook for the entire $125,000. Your business is over. This isn't an exaggeration. These are the real-world scenarios that play out every single day. The world of cargo insurance is a labyrinth designed to protect the insurance company, not you. They bank on the fact that you won't read the fine print. So what should you have had? You needed a policy that was specifically designed for your operation. You needed to have a conversation with your agent that went beyond, I need $100K in cargo. You needed to ask, does my policy cover theft from an unattended vehicle? Is there a co-insurance penalty if I'm underinsured? What are my specific commodity exclusions? Many policies have lower limits for things like electronics, alcohol, or pharmaceuticals because they are high theft targets. You might have a $100,000 policy, but it might only cover $25,000 for a load of laptops. You needed to ask about debris removal. You needed to ask about earned freight coverage. Oh, I didn't mention that one. In our accident scenario, not only are you on the hook for the cargo, but the broker is also refusing to pay you the $10,000 for the freight charges because you never delivered the load. Earned freight coverage would have paid you the money you were supposed to make on the trip, so you're not losing everything. You also needed to understand the fundamental type of policy you were buying. Most truckers are sold a named peril policy. This means the policy only covers losses from a specific list of events or perils, like fire, flood, or collision. If your loss happens in a way that isn't on that specific list, you're not covered. The superior but more expensive option is an all-risk policy. This covers everything except for a specific list of exclusions. The burden of proof shifts. With a named peril policy, you have to prove your loss was caused by a covered event. With an all-risk policy, the insurance company has to prove your loss was caused by an excluded event. It's a game-changing difference in a claim situation. Your $100,000 policy was an illusion of safety. It was a piece of paper that fulfilled a legal requirement for your broker, but it was never intended to truly protect your business in a worst-case scenario. It was built with trapdoors and escape hatches for the insurance carrier. So now you're sitting on the side of the road, looking at the wreckage of your truck, your trailer, and your business. You've received the denial letter from your insurance company. The broker is calling, demanding to be paid for their lost load. The towing company and the cleanup crew are sending you bills with 30-day payment terms. You have a mountain of debt, a broken truck, and a piece of paper that you thought was a shield, but which turned out to be completely worthless. You feel the cold, hard panic rising in your chest. What on earth do you do now? The first thing you do is breathe. Right now, your mind is a storm of fear, anger, and regret. That's normal. But panic is the enemy of progress. You are in a crisis, and in a crisis, you don't rise to the level of your hopes, you fall to the level of your training. So let's train. Let's perform financial triage right here, right now. Your business is bleeding out on the side of the road, and we're going to apply pressure to the wound. Your first instinct is to grab your phone and furiously call the agent who sold you this policy. Don't. Or if you do, understand that this call is not for resolution. It is for documentation. That agent might be a ghost. They might be part of the problem. They might give you the runaround telling you it's being processed, while they try to cover their tracks. Assume from this moment forward that every person you speak with is not on your side. Assume you are building a legal case even if you hope it never comes to that. So, the first real step is not to call but to collect. You need to find your policy's declaration page, not the certificate of insurance, that one-page document you show to brokers and shippers. That's just a summary, and it can be easily faked. You need the deck page. This is the multi-page document that is the actual heart of your contract. It lists the coverages, the limits, the deductibles, and most importantly, the name of the actual insurance carrier. The underwriter. The company whose name is on the hook for the money. Your agent is the middleman. The carrier is the source. If you don't have it in your email or your files, log into the online portal your agent gave you. Download every single document you can find. Every policy change, every endorsement, every payment receipt. Create a folder on your computer and save everything. If you can't find it, your next call is to the agent but with a new purpose. You are not asking what's happening with my claim. You are stating, I require a complete copy of my policy declarations and all endorsements, effective immediately. Use that exact language. It's formal. It's precise. It signals that you are not just a frantic driver. You are a business owner preparing for a fight. While you wait, you become a detective. Look at your old payment records. Who did you make the checks out to? Who is debiting your bank account? Is it Joe's Friendly Insurance? Or is it a name like National Indemnity, Progressive, or Great West? You are looking for the mothership, the big, boring corporate name that actually holds the risk. Once you find that name, your world changes. You are no longer trapped in a loop with a potentially shady agent. You can now bypass them entirely. Go to Google, type in the name of that insurance carrier, and the words Commercial Claims Department. Find their direct phone number. This is your second and most important phone call. When you get a claims representative on the line, you will be calm, professional, and methodical. You will need your policy number, which should be on your deck page or even your auto ID card. You will state your name, your company name, and the date of the accident. You will explain what happened, and then you will ask the most important question of this entire process. Is there a claim open for this loss, and can you please provide me with the claim number? Their answer will tell you everything. If they say yes, here's the number, you've got a lifeline. The claim exists. Now you can ask for the adjuster's name and contact information. But if they say, we have no record of this policy, or we have no claim filed for that date of loss, the ice in your veins will return. This is the moment of truth. This is where you find out if your agent simply failed to file the claim, or if you've been the victim of a far more sinister fraud, paying premiums for a policy that doesn't even exist. Regardless of their answer, you document. Get the name and ID number of the person you spoke to. Note the date and time of the call. Immediately after you hang up, you send a follow-up email. An email is a digital breadcrumb. It's a time-stamped piece of evidence. Your email will be simple. Dear carrier name, per my conversation with representative's name, Ida #and date, I am writing to confirm whatever they told you. My policy number is your policy #. The date of loss was date. Please find my contact information below. I await your prompt response. You have now created an official record. You are no longer just a voice on the phone. You are a paper trail. From this point on, every communication should be in writing if possible. If you must have a phone call, send a follow-up email summarizing the conversation every single time. Per our call, you stated you would. This creates a record of promises and timelines that can be used later. Now, let's say the carrier confirms the policy is real, but the claim is going nowhere. They're slow-walking it, the adjuster won't return your calls, and every day that passes, your debt grows. You've done the right thing, you've been professional, but you're being stonewalled. It's time to escalate. It's time to use the system that was built to protect you. Every state in the USA has a Department of Insurance or a similar regulatory body. This is the government agency that grants insurance companies the license to operate in that state. They have power, real power. Their job is to protect consumers from bad faith insurance practices. You are now going to file a formal complaint. Go to the website for your state's Department of Insurance. Find the File a Complaint section. You will fill out a form detailing everything that has happened. The date of the accident, the lack of communication, the failure to pay the claim, the financial hardship it is causing. You will upload all the evidence you've been collecting. Your policy deck page, photos of the accident, the police report, and that beautiful chain of emails you've been building. You are presenting your case to the referee. Filing a complaint does two things. First, it puts your case in front of a regulator who can investigate and put legal pressure on the insurance company. Insurance carriers hate dealing with the Department of Insurance. It affects their ratings, it can lead to massive fines, and it puts them under a microscope. Suddenly, your claim, which was at the bottom of some adjuster's pile, becomes a 5-alarm fire at their corporate headquarters. You will likely get a call from a senior manager very quickly. Second, it provides an official government-documented record of the carrier's failure to act in good faith. Should this end up in a lawsuit, this complaint becomes Exhibit A. It shows you exhausted all the proper channels before resorting to legal action. It shows you were a reasonable person being victimized by a powerful corporation. This is not a magic bullet. It won't solve everything overnight, but it transforms you from a victim into an advocate. You are no longer just waiting by the phone, hoping for a call. You are actively fighting for your business, using the tools and systems available to you. You are taking back control piece by piece. The panic is still there, lurking in the background, but now it's mixed with something else. Purpose. You have a plan. You have a checklist. You've collected your documents. You've bypassed the agent and contacted the carrier directly. You've documented every interaction. And you've filed a complaint with the state. This is your foundation. This is how you begin to climb out of the hole. But this is just the beginning of the battle. The insurance company has a team of adjusters and lawyers whose entire job is to pay you as little as possible, as slowly as possible. They are about to respond, and their response will determine your next move, a move that could involve bringing in your own hired guns. So what does that response look like? It rarely comes in the form of a check for the full amount you requested. Instead, it typically takes one of three forms. First, there's the lowball. This is the most common. The adjuster will send a detailed-looking estimate that seems official, but it's deliberately missing items, using cheaper aftermarket parts instead of OEM, or drastically underestimating your downtime and lost revenue. The number is designed to be just high enough to make you think, well, it's something, and tempt you to take the quick, easy money. Don't. It's a test to see if you're paying attention. Second, there's the delay. This is death by 1,000 paper cuts. They'll ask for one more document, then another. They'll say a key person is on vacation. They'll request a recorded statement you already gave. Every request is designed to do one thing: wear you down. They know your truck isn't earning, your bills are piling up, and your stress is mounting. They're betting your financial pain will force you to accept a lower offer later on. This is a war of attrition, and they have endless supplies. And third, the most frustrating of all, the denial. They'll cite a clause buried on page 47 of your policy, claim you violated a procedure, or argue that the damage isn't covered. Sometimes the denial is legitimate, but often it's a hardball tactic, a calculated move to see if you'll just give up and walk away. They are betting you won't read your own policy, and you won't have the energy to fight. Your first reaction to any of these will be anger, frustration, feeling of being cheated. Allow yourself that feeling for a minute, then put it aside. This is not the time for emotion. This is the time for strategy. Your job is to dismantle their position with cold, hard facts. Take their lowball offer or their denial letter and treat it like a puzzle. Go through it line by line and compare it to the mountain of evidence you've already built. They offered $3,000 for a repair, your shop quoted at $10,000? Highlight it. Attach your shop's official, itemized estimate right next to their lowball number. They valued your lost cargo at wholesale instead of retail? Highlight it. Attach the bill of lading in your contract showing the actual value of that freight. They're not paying for your downtime? Highlight it. Attach your profit and loss statements, your load history, and your contracts for the loads you missed. You are going to draft a formal professional response, not an angry email, a structured letter or PDF. You will systematically address every single point of disagreement. You'll state your position, and then you'll cite the specific piece of evidence that proves it. You have valued this repair at X, however, as you can see in the attached Exhibit A from a certified repair facility, the actual cost is Y. You have denied our business interruption claim, however. Our policy's lost income provision on page 12 clearly states we are covered. And as you can see in the attached Exhibit B, our documented losses for that period were Z. You are creating a paper trail. You are demonstrating that you are organized, serious, and not intimidated. End your letter with a clear statement of the amount you are demanding and a reasonable deadline for their revised response. Something like, we expect a revised and fair settlement offer reflecting the evidence provided within 14 business days. Now you've turned the tables. The pressure is back on them. This is the point where many claims get settled. When an adjuster sees a claimant who is this organized and this prepared, they often realize that trying to lowball or delay them will be more work and more risk than it's worth. They might come back with a second, more reasonable offer. It might still not be perfect, but it will be much closer, and you can continue the negotiation from there. But what if they don't? What if they dig in their heels? What if they ignore your deadline or come back with another insulting offer? This is the moment you have to make a critical decision. This is when you consider bringing in your own hired guns. There are two main types of professionals you can call upon to level the playing field: a public adjuster and an attorney. And it's crucial to understand the difference. A public adjuster is an insurance claims specialist who works for you, not the insurance company. They are licensed by the state and are experts in policy language, damage valuation, and the claims process. Think of them as the mirror image of the insurance company's adjuster. They speak the same language, know the same tricks, and understand exactly how to document and value a claim to maximize your payout. They typically work on a contingency fee, meaning they take a small percentage, usually around 10%, of the settlement amount. Many will only charge a percentage of the money they recover above the insurance company's initial offer. So if the insurer offered you $50,000 and the public adjuster gets you $80,000, they take a percentage of that extra $30,000. They have direct skin in the game. You bring in a public adjuster primarily for complex property damage claims, when the value of your wrecked truck, your trailer, and your cargo is the main point of dispute. Then there's the attorney. You bring in an attorney when the fight goes beyond just the dollar value of the damages. You hire a lawyer when there's a serious liability dispute. The other party is blaming you, and your insurer isn't defending you properly. You hire a lawyer when there are significant injuries involved, either to you or someone else. And most importantly, you hire a lawyer when you believe the insurance company is acting in bad faith. Bad faith is a legal term with immense power. Every insurance policy is considered a contract of good faith and fair dealing. This means your insurance company has a legal duty to treat you fairly. When they don't, when they knowingly and unreasonably delay, deny, or underpay your claim, they may be acting in bad faith. What does bad faith look like? It's them refusing to give you a reason for a denial. It's them not conducting a thorough and timely investigation. It's them deliberately misinterpreting their own policy language to avoid paying. It's them refusing to make a reasonable settlement offer when liability is clear. If an attorney can prove the insurer acted in bad faith, you can sue them not only for the full value of your original claim but also for additional damages, including emotional distress, attorney's fees, and in some cases, massive punitive damages. This is the insurance company's worst nightmare. The threat of a bad faith lawsuit is the ultimate leverage. It changes the entire dynamic of the negotiation. An adjuster who was once dismissive suddenly becomes very attentive when they receive a letter of representation from a law firm that specializes in trucking insurance litigation. Choosing to hire a professional is a significant step. It means you're no longer just negotiating a claim. You're preparing for a battle. You're signaling to the insurance company that their tactics won't work, and that you are prepared to go all the way to get what you are rightfully owed. You've presented your evidence. You've made your counteroffer. And now you've put a legal or professional expert in your corner. The ball is back in the insurance company's court, and their next move will determine if this ends with a check or a court date. And believe me, they don't want a court date any more than you do. Litigation is a black hole for time and money. It's unpredictable. It introduces a jury, a group of 12 random people, into a highly specialized business dispute. For an insurance company, that's a massive gamble. Their entire business model is built on managing and calculating risk, and a courtroom is the definition of uncalculated risk. So when your lawyer's letter hits their desk, or when your meticulously documented counteroffer proves you're not just going to roll over, a different set of calculations begins in their headquarters. The adjuster's manager gets involved, then their manager. They start weighing the cost of a legal battle against the cost of just paying you what you're owed. They look at the evidence you've presented. They see the professional letterhead from your attorney. They realize you're not just another number. You're a prepared, serious business owner who understands the game. This is the moment the dynamic shifts. You are no longer just a claimant. You are a potential adversary, and it is almost always cheaper to settle with a prepared adversary than to fight them in court. So the phone rings, or an email arrives. It's a new offer. It's almost certainly higher than the first one. Maybe it's not everything you asked for, but it's a significant jump. This is the moment of truth. You and your advisor need to look at this number with cold, hard logic. Is this new offer fair? Does it cover the actual damages, the downtime, the real costs to your business? Compare it to your own calculations, to the quotes from your trusted repair shop, to the financial losses you've documented. This decision isn't just about the dollar amount. It's a business decision about risk and reward. Let's say the new offer is for $80,000, but you and your lawyer believe a jury might award you $120,000. That $40,000 gap is the gamble. Going to court could take a year or even longer. That's a year of depositions, legal fees piling up, and immense stress. A year where your capital is tied up, and there's no guarantee you'll win. You could walk away with that $120,000, or you could walk away with less than the $80,000 they're offering now. Or, in a worst-case scenario, nothing. So you have to ask yourself, is the possibility of getting that extra $40,000 worth the certainty of a long, expensive, and stressful legal fight? For some, it is. If the principle is what matters, or if the lowball offer was so insulting that it has to be challenged, then court is the path. But for most business owners, a check in hand today is worth more than a potential jackpot in 2 years. This is where you have to separate emotion from business. You might be angry, you might feel wrong, but you have to run the numbers. If the settlement on the table makes your business whole and lets you get back on the road and earning again, it's often the smartest move. Let's say you decide to accept. The fight isn't quite over. You will be sent a settlement agreement and a release of liability. Do not, under any circumstances, sign this without having your attorney or a trusted legal expert review it line by line. This document is written by their lawyers for their benefit. It will state that in exchange for this payment, you agree to release the insurance company from any and all future claims related to this specific incident. This is standard, but you need to understand what it means. Once you sign and cash that check, the book is closed. Forever. You can't come back 6 months later and say you discovered more damage, or that your downtime costs were higher than you thought. It's a full and final settlement. Your expert needs to ensure the language is precise, that it only covers the incident in question, and that it doesn't contain any hidden clauses that could harm you down the road. They'll also verify the payment terms, how and when you will be paid. Once you're satisfied, you sign. The check is cut, and you can finally breathe a sigh of relief. The process is over. Looking back, it's a brutal journey. From the moment of the incident, that gut-wrenching feeling of metal on metal, to the final signature on a legal document, it's a marathon of stress, paperwork, and negotiation. But through this entire series, we've laid out the roadmap. We've shown you that this seemingly complex world has rules. It has a language, and it can be navigated successfully. It all boils down to a few fundamental principles. First, preparation is everything. The work you do before an incident ever happens is what will save you. That means choosing the right policy, not just the cheapest one. It means understanding every line of your declarations page. It means installing dash cams, keeping meticulous records, and having a rock-solid post-incident procedure that every driver knows by heart. You build your armor long before you go into battle. Second, documentation is your ammunition. In a claims dispute, the person with the best records wins. Period. Photos, videos, police reports, witness statements, maintenance logs, financial statements showing your revenue. Every single piece of paper, every digital file, is a weapon in your arsenal. Don't just collect it. Organize it. Present it professionally. Make your case so undeniable that they have no choice but to take you seriously. Third, never accept the first offer. Understand that it is a tactic, a starting point in a negotiation. It's designed to see who is paying attention, who knows their own value. By calmly rejecting it and presenting a counteroffer based on your flawless documentation, you change the entire nature of the conversation. You are no longer a victim asking for help. You are a business partner negotiating a contract. And finally, know when to call in the professionals. Your insurance agent is your guide, but a public adjuster or an attorney is your champion. They are the specialists you bring in when the stakes are high. They level the playing field. The moment the insurance company realizes they aren't just dealing with a trucker, but with a trucker who has an expert legal team, their entire risk calculation changes. It's an investment that can pay for itself 10 times over. This isn't just about insurance. This is about the fundamental nature of being an owner-operator or running a fleet in America today. You're not just a driver. You're a CEO. You're a financial planner. You're a risk manager. Every day, you navigate a world of logistics, regulations, and economic pressures that would crush the average person. Insurance is just one more part of that complex machine you have to master. The goal is to never be a victim of circumstance. It's to be the master of your own business, to build a company so resilient, so well prepared, that when a crisis hits, and it will, it's just another problem to be solved, not a catastrophe that ends your dream. The road is long and unforgiving, but it's also the path to freedom and prosperity. Protecting that path, protecting your investment, protecting your livelihood, that's the whole point. You haul the goods that build our homes, stock our shelves, and feed our families. You are the lifeblood of the economy, and a business that vital deserves a defense that is unbreakable. Master this world of insurance, and you're not just buying a policy. You're buying peace of mind. You're buying security. You're ensuring that no matter what happens out there on the asphalt, you have the strength and the resources to get your rig running, get your wheels turning, and keep on trucking. Because in this industry, the most valuable cargo you'll ever haul is knowledge.